I want to take you through our first case study, and this is a scenario that we do see every day. It's a trading business with commercial property on the balance sheet. And this case study will show you how we can protect the property from creditor and trading risk while also getting a significant corporation tax reduction in year 1 with further reductions in years 2 plus. So okay, let's have a brief look. Okay, so this is ABC Restaurants Limited. They're a successful chain of restaurants, and as far as accounting goes, everything is ticking along quite nicely. The business is run by a husband and wife team, and they've got 2 adult children. They've got multiple properties on the balance sheet, with the smallest one currently being valued around £300,000. Now, the only item that's been flagged up by the accountant is the balance sheet asset value, because if they carry on adding properties, they'll exceed the £5.1 million threshold, and that will require them to have audited accounts, which would add an element of additional cost and administration to their already busy lives. The properties that they have are actually exposed to both creditor and trading risk, and although they've come through the pandemic successfully, they're actually very aware of the fact that these properties are indeed potentially exposed to what may happen in the future. The company is also close to paying corporation tax in advance because their profits are getting close to £1.5 million per annum, and that basically means that they become a large company under HMRC rules and they'd have to pay corporation tax in advance, which in cash flow terms is something that would cripple them because they'd end up having to pay corporation tax before they earn money, because their income tends to be very seasonal in the restaurant business, with Christmas and Easter being their 2 big seasons. So let's have a look at the first bit of planning that we're proposing for them. It's to establish a SSAS, small self-administered pension schemes. And we have the company ABC Restaurants acting as the sponsoring employer, and the husband and wife began the process of establishing the SSAS, but instead of simply developing a business tool, they decided to add their 2 grown-up children to the SSAS, and that turned the SSAS from, like I say, a corporate tool into an amazing tax-exempt family trust, because now we've got all 4 involved. We've actually opened up opportunities to not only increase the funding to the SSAS, but also to pass money down the generations, which makes it the most secure, tax-efficient family trust available. We'll be looking more into this family trust use of SSASs in another case study. The next step in the planning is normally to make a contribution into the SSAS, and this is where the sponsoring employer normally transfers money across into the SSAS bank account. The amount that can go across is something we're going to look at in detail on the training. One point we wanted to draw here was that individual directors are allowed to have directors' remuneration in the accounts made up of contributions to the SSAS. So the son and daughter who are new directors, who aren't on a salary, can actually have contributions made to the SSAS, and that would be defined as their director's remuneration. We can mop up previous years, and in total, subject to a prevailing wind and everything being correct, we can go as high as £160,000 per person going across into the SSAS in terms of getting corporate tax relief. In addition to that, if the company is making huge levels of profits and wishes to put money into the general fund, you can go higher. And in fact, you can go as high as £500,000 going across from the limited company into the SSAS and still get the tax relief within the first year. But like I say, we'll go into that in more detail during the detailed training. But in this particular case, the company doesn't want to move cash across into the SSAS. It's actually got a property, and we're going to do an in-specie contribution of that property straight across into the SSAS. And this is a useful process for clients where there is no cash available, or the cash has been earmarked for some other business activity. It's a very useful thing to be able to make asset contributions straight across. However, a lot of you may remember last year HMRC won a landmark in-specie tax ruling, which basically says the pensions can't get tax relief on in-specie contributions. However, the eagle-eyed of you will notice the word SIP at the top of this article in the Financial Advisor. It's really important to understand that this ruling only applied to self-invested personal pensions, doesn't apply to corporate pensions, and a SSAS is indeed an occupational corporate scheme. So we're able to do in-specie contributions and get corporate tax relief. So we have made an in-specie contribution into the SSAS. But what on earth does that mean for the client? So let's have a little look. Okay, so the first thing they get is corporation tax relief on the £300,000, which to them is worth £57,000, and they receive that tax relief without physically having to spend £300,000. All they were doing is moving a property. The balance sheet has been reduced by £300,000, so they've got a bit more wiggle room in terms of not hitting that £5.1 million balance sheet ceiling, and this is an important one. If you're taking assets off the balance sheet and moving them across into the SSAS, we've got to be careful that we don't impact any creditor or suppliers who may be interested. So this we go into in more detail on the training sessions. Of course, now they've got a SSAS, they can make annual contributions, and there's 4 members, so they can make larger contributions, and on an ongoing basis, that is now moving money out of the limited company and across into a tax-exempt environment, which can drop down to the son and daughter, avoiding inheritance tax as well. We've also got rent, which is coming in on the property which is owned by the SSAS, and that reduces the taxes even more. And the important thing to note here is that £27,000 rent is over and above the maximum personal contributions that can be made or allocated to the individuals. So it's a good way of bumping up the amount that can be paid into the SSAS. And of course, in addition to that, the rent money is passing from the company and is becoming family money to be invested within the tax-exempt structure without triggering any taxes on that money coming out of the company. Having a family SSAS actually passes value down to the children free from tax, and there's a lot of things we need to go into in this in more detail, hence we've got a death planning case study. So if you want to know more about how a SSAS can be used effectively as a family tax exempt trust, then do look at the death planning case study. Okay, so that was case study 1, a brief and very quick run through of in-specie contributions of commercial property. Don't forget we have other case studies for you to watch, but we can't cover everything in these short case studies, and that's why I keep referring to the training sessions. That's where our professional partners get the opportunity to sit and ask questions. Our job is to make sure that you are comfortable in receiving CPD training so that you know how to spot and recognise opportunities.